Hello Africa, welcome to Investments for Impact, a Vilgro Africa podcast. In this season, we are focused on the topic of fundraising. Welcome to our 5th episode, where we discuss venture capital as a source of funding for startups. Thank you for joining us. Welcome. We are joined by two awesome guests today, Arnold Maina from DOB Equity and Jason Musyoka from Here Ventures.
Thank you.
So to get us started, maybe just introduce yourselves and tell us a bit about yourselves and your companies.
Yeah, happy to go.
Please.
Thanks so much, Moses. It's an honor and a pleasure to be here. Fantastic what Vilgro is doing with the space.
Thank you.
Just quick intro. My name is Arnold Maina. I work for DOB Equity. I'm part of the investment team as an investment manager. And we invest in startups across East Africa. We've been investing since 2007. And when we make investments, we are investing from an evergreen fund, meaning when we invest, we don't have to exit within a specific timeline. We raise our capital from a single family in the Netherlands. And for them, their interest is to invest in businesses that partner, serve, and work with low-income households. So in essence, we're impact first. And when we invest, we look at investing in scalable, tech-enabled businesses. Yeah.
Thank you. Arnold, perhaps you could just clarify, what does it mean to be impact first?
Okay. Yeah. I think how I describe it is we look at 3 categories. To be impact first is to consider social or environmental impact or the consequences of a business having on social and environmental ecosystem. Yeah. So for us, how we look at it, we look at what is this business doing to empower people? What is it doing to ensure that planet is thriving? And 3, what is it doing to increase or improve the markets in which we are operating?
Wonderful. Thank you. Jason?
Thank you so much, Moses. Similar remarks to Arnold about the work Vilgro is doing. So my name is Jason. I'm the investment director at From Here Ventures. We are a fairly new fund, launched last year in June. Already have 7 investments.
Wow.
But the thing is that we are growing that fund from a venture building company that was trying to do a bit of venture building earlier on. So that's generally what I'm doing currently, but previously I've been in the VC space for the last 8 or so years. Started out in early stage angel investing and tried a bit of angel investing myself. Didn't work out that well, but learned a bit of things here and there. Happy to share that as well. But yeah, that is pretty much my background. So what the fund does is similar to Arnold. I think we are a bit early stage, pre-seed and seed, tech and tech enabled and not sector focused. And we look at anything in the Eastern African region. So our investments cut across Rwanda, Kenya, and also Egypt now.
Yeah. Great. So are you also impact investors?
No.
Okay.
Not that. Let me clarify that. Because I think any capital or resource deployment in Africa, to some extent, will create some form of impact. But it's just that we don't measure the things that Arnold is measuring. As we are more capital focused in the sense that we have a certain return expectations on the companies.
So you would probably be more a commercial investor.
You can look at us like that.
Okay,
yeah.
Thank you. So you said something about having been in the investing space for the last 8 years. And that's interesting for me because I guess you have background. I don't know how long you've been in the space, Arnold, but you can speak to it too. So I'd like to find out, what have you observed over those last 8 years? Like, how did the space look like when you got in, and how has it evolved to date?
Well, that's interesting because some things have changed, some things have not changed. But at least what has increased over time is the interest of the larger African ecosystem for foreign investors. I think capital deployed, and this is public knowledge anyway, I think people can go and see how that has grown over time, capital that has been deployed in the continent. Some regions have received most of it, some regions have not received most of it. Some sectors have become quite interesting, some sectors have stopped being interesting. So a couple of changes here and there, but I think predominantly when it comes to the caliber of entrepreneurs, they're more ready now in terms of speaking to investors than they were previously. And I guess that's thanks a lot to a lot of ecosystem building as well. And also now we have seen an influx of investors here, so that access to capital has been quite good in terms of increase of where you can look for capital, both impact and commercial as well. And also you have seen very sector-focused investors that have come in instead of just generic investors. So if you're trying to innovate in a certain sector, then you're more likely to find more investors in that sector right now. So those are a couple of changes that we have seen. What has not really changed is how access to capital, especially for local entrepreneurs, has been. That is still a challenge, and I don't know how long that will take. We need to see more participation of local capital before we see an uplift in access to capital for a lot of more local founders. So that is still has some slight improvements, but it's not entirely where I think it should be.
Thank you. And I'd like Arnold to answer that question too. But before that, I like what you said about local capital. Could you expound on that just a bit? What do you mean when you say we haven't seen an increase in local capital?
It has improved. Local capital has improved.
Okay.
Also that it's just that it's not gotten to a point whereby it can move the needle to the extent that you want it to move the needle. I mean, compared to more mature ecosystems, which have a very vibrant local capital base, and then they can, up from there, then you can get more institutional investors. By local capital, I essentially mean angel investors, really. These are people who look at very early companies and they try to see how they can support them before the likes of Arnold and their big checks can come in and give you the boost that you want to move forward from there. So that, the last 5 years, we are seeing a lot more interest and participation in that, and as compared to previous years, but for factors that pretty much common in the sense that the asset class is very new. So local investors don't really understand it. It has taken them a bit of time before they understand the likes of, people being in the ventures we see like Arnold and myself, then we understand that sector. So we can deploy personal capital there. But majority of the people that have capital still don't understand the asset class. So it takes a lot of capacity building for them to get to understanding that asset class. And thanks to VCs like, ourselves and Arnold, who have pretty shown the interest in locally innovative businesses or businesses that are trying to innovate here, then there's a possibility of trying to make that asset class very interesting. So that is still being improved, and really waiting for the day to see that kind of local capital increase, and then you can really get to a point where now Arnold can say, I have a large chunk of companies that I want to invest in.
Great.
Yeah.
So Arnold, going backwards to the question on trends.
Yeah.
How long have you been in the space, and what have you seen change over the time you've been there?
Yeah. So just a bit of background. So I started off my career in corporate finance, working for one of the big fours. Our work was advising multinationals or investors in Europe to invest in Africa, specifically East Africa. And so they would come to us for us to do due diligence. And really then what I'd see a lot more of is large private equity companies, private equity funds making investments in the ecosystem. That's what I was exposed to. And then 2017 moved into direct impact investing. So I've been doing this for the last 6 years. And I echo what Jason has said. The things that I see have changed, and it's fantastic to see them change, is I think there's a lot more visibility of Africa across the globe. Why? Reports have been written that give context on how capital is being deployed and the opportunities that exist in the different verticals. So more from a global standpoint, more people have an idea of what they should be looking for when coming to Africa, because there are all these market players in the ecosystem that are writing about the local context, Brighter Bridges, Disrupt Africa, and the work you're doing with the podcast, right? It goes international, and there are people listening and paying attention. 2, you've seen exits start to happen from the likes of Jumia listing in the US to the likes of Paystack being acquired by Stripe. All of those small steps are in the right direction, because now people are paying attention to the fact that, yes, there's a demographic dividend in Africa, there's a lot of opportunity, a lot of unmet needs, and there are companies trying to solve those needs. I think the third thing that I've seen happening is some of these entrepreneurs who've been building are now reinvesting, and you see that a lot in Nigeria.
Wonderful.
And we'd like to encourage more entrepreneurs to build their businesses so that they can exit and invest in the next generation of entrepreneurs, because that's the only way we'll have more local capital, as Jason said.
Yes.
Being invested locally.
Yeah.
Around local capital, the thing I'd add is, when you look at the US and all these other developed markets, the most liquid players in their ecosystems are pension funds, insurance companies, endowment funds from universities, etc. It's only until recently, I'm talking about the last 4 to 5 years, that our retirement benefits authority added that you could invest in private equity, and that they get regulated on the percentages they can allocate per asset class. And private capital or private investments was never something you'd allocate. Majority of the allocation would be government bonds and real estate. But even the regulators in these spaces are sort of ushering in new ways of raising capital. And so the likes of Ascent Capital were able to raise locally. And I think that's a big win for the ecosystem. Yeah.
The Africa of 10 years ago, even the Kenya, for that matter, of 10 years ago, is not the same. A lot of things have happened from a macro and even now country-specific micro perspective. Infrastructure development, connectivity, access to smartphones, and all these things have enabled a lot more innovations to come out of that. So from an opportunity perspective as well, that has also increased. I mean, previously, maybe 10 years ago, you could find very few deals in the fintech space because the infrastructure layer was not yet that much advanced. Or you could find very few mobile applications because that penetration was not yet that big, or connectivity was an issue. And then also other things from a macro perspective, also you have to look at the SME space in the sense that what does that enable from government to government, or setting up policies that can enable bilateral trade, at least, because that enables ease of movement of goods and services. And since you catalyze that commercially, that catalyzation of commercial activity is boosted, then you see a lot of things really coming out of that. You see innovations that are trying to drive efficiencies in traditional industries. You see a lot of innovations that are coming build up on infrastructure that is already there. We see infrastructure taking off, innovations taking off because of that smartphone penetration and also data access to data. So all that has really changed a lot in terms of innovation and also availability of opportunities in Africa. So it's a different space right now.
Wonderful. Thank you. So
and population as well.
Yes. So the population is growing.
Yeah, it's growing.
Infrastructure is being developed.
Yeah.
The SME space is growing, creating opportunities for businesses. Then there's lots of reporting happening, opening up the space to outsiders from out of the continent, and I suppose also reducing the perception of risk, which is something we spoke about in a previous episode of this podcast. I think that's actually crucial in just opening up the space and tackling that whole narrative that Africa is a dark, risky continent.
Yeah. It used to be that Africa was this opaque box. No one knew what came out or what went in. But, like you're saying, the risk is being demystified by people writing and actively highlighting companies doing well. Yeah,
wow.
Fully agree.
Thank you. So, we're talking about venture capital investment in this episode, but we haven't quite delved into what that means. So a lot of our viewers are startup founders, and we'd like to help them understand what exactly do we mean when we say venture capital, one. And two, if you could elaborate to the extent where you describe the kind of tickets that we're talking about, but also differentiate venture capital from other types of asset classes as you highlighted earlier. So starting with you, Arnold.
Yeah. So to just remind the audience, one, when we are making investments, the first box that needs to be ticked is, are you having an impact on the low-income households? We talked about being impact first. So for us, we want to see that these are the specific tangible ways that we can measure that you're impacting those that target market. It's a key KPI for us. It's a key KPI for the family that provides us the capital to invest. Now, beyond that, investment ticket sizes, they range for DOB equity. It ranges from $250,000 all the way to $5 million. And we have a sweet spot of about 2 million, meaning we will invest in companies that are pre-Series A We might come earlier at the seed stage, but we can continue to follow on. Because of the Evergreen Fund and the source of our capital, we tend to be patient, and that means that we can follow on across multiple stages of raising funding. And one last sort of comment to highlight is when we come in with smaller check sizes of $250,000, we're saying we want to invest that specifically in local entrepreneurs or local and female entrepreneurs, basically underrepresented founders who aren't getting the capital to get them to the next stage. And as DOB, we want to co-invest with others in that specific space, because we often find that these companies have a smaller ticket size requirement. And so if you say your minimum is $500,000, then you leave out a lot. However, there are even earlier stage investors who do 100 and lower or 250 and lower. But for us, that's the ticket size range we play in. But to go back on your first question, if I was to, not give you the textbook definition, for me, how I see venture capital, it's an entrepreneur has an idea. They see the future very differently from what it currently is. Venture capital is meant to come and enable them to create that future. And that's what really excites me about the work that I do. We are changing how customers will access products, how families will access healthcare and be served, how homes will access electricity. It's really about creating that future. And because of that, this capital tends to come in when the company is very early stage. If the company has a product that is refined and is appreciated by the market, meaning customers are willing to pay, then we provide them with the capital to accelerate their growth, so that you don't take 20 years to build an established company, but you sort of leapfrog that by having a minimum viable product that has a good fit with the market and customers who are willing to pay. And so our capital comes in early stage to fuel that acceleration of growth so that you can create that future sooner. And in contrast, you've got private equity that tends to invest in very established businesses where you know how predictable the business will be the next 3 years based on how it's performed. With venture capital, the target market or the companies we're investing in, we don't know what the future is going to look like. So chaos, but good chaos, because it creates that disruption that creates that future.
Wonderful. Thank you. Anything to add, Jason?
No, I think that should be taken as a textbook definition of venture capital, because it's spot on. I mean, people can get confused in this textbook description of what VC is, and most of that description is not coming from a market like this one. It's coming from a more mature market, and I like the way Arnold has really simplified it. It's just helping an entrepreneur get from point A to point B sooner than they would have taken initially.
Great, thank you. So now, moving on to issues of selection and sourcing. So I'm curious to find out, do you have challenges as far as sourcing is concerned? So how does your pipeline look like in terms of volume and quality? Is it at a space where you feel it's comfortable, or do you feel that there's room for growth? And if so, what would you like to see change?
Yeah, so like we previously mentioned, I think we are seeing a lot more opportunities right now, and there are a lot of ecosystem players that are trying to surface these opportunities. A lot still needs to be done because there are a couple of entrepreneurs that are still not visible to investors like Arnold and myself. And out of that is the kind of entrepreneurs that might not necessarily have access to these ecosystem players, then who can surface them. So we still need to do a lot of work there. And maybe just to add on to that, deal sourcing is very, I wouldn't say it's proprietary. I mean, you can have some proprietary deal flows, but also at the same time, you need to work with other people so that at least you can see, they can put you before entrepreneurs that you did not initially have access to. So most of our channels, of course, are coming from the usual routes of accelerators, incubators, partners, other venture capitals that are playing in the same space. I mean, Arnold could see a deal that is not ready for them, but they might be ready for us because our checks are a bit smaller. And Arnold can, with one check, he can fund us. But yeah, so we need to collaborate a lot, and I think a lot more needs to be done in terms of collaboration, especially in the VC space, whereby you need to network with other people so that if they can surface deals for you that might not be right for them. So we need to really work a lot on that element of collaboration, but also in the ecosystem play aspect, the interactions between VCs and ecosystem players like accelerators and incubators need to be more, closer, because then they can surface deals that might be ready from an investment perspective. Because if you know the kind of theses that investors use to make investments, then you can prepare companies in that direction. So I think a bit of that needs to be done as well.
Okay, it sounds.
And another channel that could be very interesting is also the university, because we don't see a lot of. If you look at more established ecosystems, you see opportunities coming out of incubations from universities.
Yeah.
But if you see at least I can speak for the case of Kenya, we don't see a lot of that. Of course, there are some programs that are trying to address that. But the more of those kind of programs that we see, then we start seeing well-researched opportunities really coming out of universities that can have commercial potential. And then those can be taken up by VCs or even early-stage investors. They can to commercial stage. And then on that, then you can really get very good innovations coming out of that space as well.
Great. It sounds to me like you're saying that you're happy with the volume of pipeline currently available, but you feel like there are blind spots and that there are still interesting deals out there that
needs to be surfaced.
Yeah, that are not being surfaced.
Yeah.
Arnold, could you maybe speak to that too? What are your thoughts?
Yeah, I think I see similar things. Meaning, one, I see a lot of companies that now have access to investors because the number of investors has grown. Coming out of COVID in 2020, 2021, you had an influx of capital. And there are more investors and more networks. People are more open to considering investments in this region. However, I have to admit that there's maybe some misunderstanding in what the investors are seeking and what they consider to be traction enough for them to fund versus what the entrepreneurs understand. So that misalignment in expectations tends to come up. And I guess that's why we have conversations in spaces like this where we clarify this is what we tend to look for when looking for startups. So in simple words, one, there are a lot of companies looking for capital. What is missing is a clear understanding of when should I be raising from this type of a player versus this other type of a player.
Yes.
It's more so just us as the VC space and the ecosystem helping the entrepreneurs understand at what stage should they be reaching out and what metrics and indicators we're looking for as investors. Yeah. So the quality question then comes in. So there's a large volume, but the quality of companies, I think we can see that there's still room for improvement there. So
maybe then how we could look at it is from an entrepreneur point of view. How do I know that I'm ready for VC investment?
Yeah.
But then also, how do I know that I'm not a fit? Because I suppose it would be helpful for you, for companies that are not a fit to not bother approaching in the first place.
Well, yeah, interesting point. Maybe a different view slightly.
Yes. Well, actually, I was going to say next that, you see, on the other hand, you don't want potential entrepreneurs to disqualify themselves.
Yes, exactly.
Too early. So anyway, if you could speak to those tensions.
Yeah. Okay, so there's a question you asked earlier about what do I think is missing? And Jason mentioned we need people in the ecosystem to work closer together. One fantastic thing that I keep seeing time and time again is this ecosystem is very collaborative, and that's a strength, and we shouldn't lose that. When you look at more developed markets, the competition is stiff and it's really competitive when when a company is raising capital, as soon as you get the first check in, you want to be in that deal and you'll do whatever it takes to get there as an investor. In this space, we share learnings. We want to work together. We want to co-invest, not just because our ticket sizes don't align or don't overlap well, but because we see each other as bringing different types of value. So From Here Ventures has a different perspective, and they have a very strong local team that's able to give more insights into other trends, and so do we, but we want to share learnings based on different experiences. What I'd like to see happen is, one, more local capital. I said that it's starting to show up. We need it to show up more. Because then the underrepresented founders would then have the money they need to get to the stage where they can raise capital from larger VCs. So that's one. Two, exits. And this has nothing to do with founders at this early stage, but down the line, the more companies, the more high quality businesses that are profitable exit, the more capital will flow into our continent.
Yeah.
Right now, we're just deploying 1% of global venture capital funding. And if you look at the size of Africa, we've got a massive population and we're large on the actual map, not the one we see in the textbooks. The continent is bigger than it seems. So we should be doing more than just 1%. But it'll take time to get there. But to the previous point you asked about how do entrepreneurs know whether they fit or whether they don't? One, I would encourage you to have conversations. Don't disqualify yourself, even when you don't think you're not a fit. Because, like I said, we're investing in entrepreneurs creating the future. Even we don't know what the future is going to look like. And so we tend to have a very opportunistic lens where we want to know what you're building even before you get started or as you're getting started, because we'll track how well you're doing over time. What I'd encourage founders is not to get disappointed if they don't get an investment immediately, because it's the long game. VC and investing is a relationships play. I might not invest today, but I'm keeping an eye on you because if I like what you're building, I want to invest tomorrow. So my advice to founders would be, have those conversations early and look at it as a ladder. An investor who wants certain metrics to invest will invest maybe a year, 6 months from now. You should keep in mind what those metrics are so that you work towards them. And that actually encourages us as investors because, one, the founder listened. Two, the founder followed through.
Okay.
Yeah, I mean, just to add on to what Arnold has really said, and in terms of what is really missing, the first thing I would like to say is that I don't think all startups in Africa are venture startups.
Yeah.
Not
Great.
all of them.
So true.
I mean,
Yeah.
we have this mentality and thought frame of saying I have to be a VC fit. No, you don't have to be a VC fit. You can be another fit. And also that touches onto the idea of how venture capital should be undertaken in Africa. I think the model of venture capital from a time perspective, and this is actually the VC model that I would think works for Africa.
Yeah.
An evergreen fund that is not focused on when am I going to get an exit? Because then an exit pressure is not for you. Your LPs are like, you know what, take as much time as you want. But of course, I mean, I don't know if there's any LP who will ever take as much time as you want. But this more or less is a fit. From a venture model perspective, I think an evergreen fund or a long-term fund is what fits properly in Africa, because Africa is very different. It's not one market. It's 50, how many countries? 50? Something. So that's not one market. Scalability, it's very nuanced. You just don't take what has worked in Kenya and take it to Uganda, your neighbor, and you think it will work there. So venture capital has to change in Africa, and the mindset of startups or entrepreneurs in Africa has to change. Not all businesses are venture businesses. You can just get to growth organically, or you can get the kind of capital that can take you to growth. And then on that basis, keep on building. So that's the one thing I would like entrepreneurs to understand, that if you're not a venture fit, you're not a venture fit. And the second thing is that, look, just to echo what Arnold has said, you have to learn to network very well. I don't think the one thing entrepreneurs need to learn is how do they get in front of investors that are fit for them, because you just can't talk to every investor. You're in the fintech space, but then you're talking to someone like in the agri space. You're just wasting time there. So the second thing I would like entrepreneurs to do is just to understand who might likely fund you. Once you understand who might likely fund you, because this idea of talking to 300 investors and then you just get 1% of that to invest in, I think that's a lot of crap. You can just identify the investor that is most likely to invest in you, and you just need to talk to 10 of them. And one of them or two of them will invest in you. So you have to get out of this mentality of saying, manze fundraising, I have to hit 400 investors. How many have I talked to in this week? Just tell me every investor in this freaking region that I'll talk to all of them. That's just nonsense. Not all of them will invest in you. So learn to talk to the right investors. Once you identify who's the right investor that can invest in my company at this space, then go talk to them. They could be 10, but just talk to them.
In any case, Jason, how can I tell whether I'm a venture backable startup? What questions do I need to ask myself to know?
I guess the first question is, how does a venture company or startup for that matter look like? And I think Arnold touched on that a bit. It's, can you achieve, ventures work with massive scalability, large markets, or very large market segments, and they look at it from a growth perspective. They chase the growth numbers, the top line numbers, as opposed to the profitability and other things like that. So for venture-backed startups is companies that have those kind of characteristics. So if you don't have that kind of characteristics, maybe that's the first thing that you need to ask yourself. And then the second thing is that ventures tend to go for a lot more for asset-light companies. So if you are very heavy on the infrastructure side of things, and if you think your market is not, it's a very niche play, or it's a market segment that might not give VC sort of returns, then maybe you're not the right company for a VC play. And even other things is that the type of an entrepreneur you are, what kind of business are you building? Are you building a lifestyle business whereby you just want to generate income for yourself so that at least you can maintain a certain lifestyle? Then you're not a venture-backed company, or a type of company that can be backed up by ventures. I mean, that list goes on, and I'm sure Arnold can add a lot more to that, but I think those are the ones that at the very least come to mind. So type of business you are, the type of market you're operating in, the business model that you have, those are some of the things that you need to look into before you answer for yourself if you're a venture kind of company.
Yeah, I think, just to concur with what Jason said, can I be $100 million revenue company? That's number one. Yes or no?
Wow.
Can I be Pan-African? Because being in one market might not be as exciting as being in multiple markets. Do I want to build a company where I have other stakeholders who will demand that growth? Those are some of the questions that Jason is highlighting. There are alternative sources of capital, and I can give context. So if you say no to those questions, then you'd be looking for funding from companies that offer revenue share financing. That's an alternative to venture capital, where you get your funding tied to your revenue and how you're performing. You can get debt from, local banks who are still coming to terms with how the market works and educating themselves. But there are banks out there who want to fund startups, but you definitely need certain key criteria to fit for them. So like collateral, but it is an alternative source of capital. And thirdly, the best source of capital that's often understated is your customers.
Yes.
Are they buying your product? Are you making a margin to reinvest in your business or to grow your operations? In fact, you should be asking yourself, with my customers, can I just grow this business without raising external capital? And, that would be a fantastic place to start, where then you say, I'll add these other sources of capital afterwards. Yeah.
Okay. So now that I'm a fit, how do I prepare for that first meeting with an investor? And beyond that, from the investor side, perhaps speak to expectations. How long does it actually take from the first meeting to the point where you get a check? And I ask this question because we see a lot of entrepreneurs not sure about when to start raising. You come too early and you're not interesting enough. You wait too long and you've run out of runway. So could you guys speak a bit to that, starting with you, Arnold?
Yeah, I think how should you prepare, or when should you have that first conversation? I think once you've decided that you want to build a venture-backed business, then I would encourage you to start conversations with incubators, advisors, and people within the investment teams of VCs. What you're trying to get an understanding of is, one, do you see investors actively investing in this space? That's one. Two, what metrics do we need to show as a company to get them interested? I wouldn't even be saying, hey, I've been building this business for X number of years. This is my traction. I'd want to understand, what do they want to see first? Yeah, but obviously give them context to what you're building and what sector and your business model. Understanding their criteria will guide you on how you should build. So I would say you've got a business on paper. It's not a concept. You actually have customers who are buying your product or service. You've seen some growth coming through in terms of your revenue. Have that conversation at that point, because then you get feedback immediately on what are the leading indicators they want to see, and at what point would it be best for you to come. Is it 6 months from now? Is it a year? Is it when you hit certain revenue milestones? Etc. Yeah. So I'd say as soon as possible, when you have customers who are actively buying your product, and you can articulate the problem and solution you are providing. Yeah, your problem you're solving and the solution you're providing.
And I think he's absolutely right. It's just that what I'll caution entrepreneurs to do is that don't build a business for VCs. Build a business for the market, for your customers. Just focus on your customers, because there's this idea that, and especially we saw it pre-recession, whereby entrepreneurs were chasing numbers for VCs. If you keep on building a business chasing numbers for VCs, you might get disappointed, because the market is, as you say in Kenya, msema kweli. So that is where build a business for the market, build a business for the customers. VCs will come. So, but it's good to have those kind of conversations that Arnold is talking about, so that you know, how do I prime myself for that conversation? Yeah, but back of your mind, just always remember you're building a business for the market, for the target consumer. If you keep on chasing milestones that VCs are setting up for you, then you just end up building a business for them. But then the underlying product or the service, customer experience is very bad. So build a business for the customer first, and then the VCs will come. Yeah. They'll find out where you are. They'll keep on talking. They'll be told that there's this company that is really doing very well in the market. Yeah. Why don't you talk to them? And I've seen companies like that are surfacing actually during this recession, and others that were chasing numbers for VCs are going down. So you have to be very careful on what you do when it comes to venture-backed opportunities. You have to be very careful of what you're really chasing.
Yeah, I think maybe to add to what you said, Jason, it's funny you say that. I agree with that 100%. Do not build your business with me as the VC in mind. Build it with your customers in mind. And it's based on those results that you'll raise capital from a VC. I'll give you an easy sort of example. When we now start talking as a VC and an entrepreneur, I'll actually go speak to your customers to find out, what about the product do you like? What do you want to change? How well has the service been? So if you're not solving for that customer, I'll quickly know, and then I'll say, okay, they're not ready yet. And I'll give you the feedback that actually some customers are not too happy. So if you're not solving for them, then the answers they give me won't be in line with what you're building. Yeah.
Anyway.
Yeah.
Absolutely.
Yeah. So, yes.
Just to riff.
Yeah.
And when it comes to timing or how long you should raise for them, I think rule of thumb is before you run out of money.
Yeah.
Ideally,
how long before?
Let's say at least 6 months before you run out of money, because any typical process, it's different process to process. Ours is like 2 months before you get a check from us.
Ours is 4 to 6 months, depending on how big the check is.
Exactly. So you need to position, at the very least, give yourself a good time frame, because we'll talk to 5 Arnolds before you get a check from one. So give yourself time before you run out of cash. That's a rule of thumb.
What are your long-term aspirations for the VC space in Africa, and how do you see it evolving, and what role do you want to play in it?
Okay. Yeah, happy to give my thoughts. One, I'd love to see more capital coming from local investors. Not because foreign capital is bad, but because a balance is needed. And it's important to have local capital investing in local ideas because of we understand local challenges.
Validation too.
Yeah. Two, I'd want to see more entrepreneurs getting into the space, succeeding and exiting. If we as the VC industry struggle with exits, it becomes difficult for new first-time fund managers to raise capital. So I'd love to be in a place where there are multiple exits and there's a path to that exit. And it brings together everyone to work together to create that from happening, from coming to fruition, from people in our capital markets to our local banks to provide the capital they need to help the companies grow, to us as investors working with the entrepreneurs. So I'd love to be in a space where we're saying, oh, this year we had 50 exits. That would be super exciting because then we know that more capital will come. And I think the last thing would be, in this period that people are raising capital and founders are building their businesses, we need to redefine what VC is for the African market. Mm-hmm. And I think Jason highlighted it. Mm-hmm. And I think it's an important point that we have to come back to. Exactly who are we building for? Do businesses need to be profitable? We know how hard it is for businesses to scale without being profitable in the African context. Mm-hmm. You could have Uber or Twitter or all these other global companies scale and list without being profitable, but we can't think that can be the same thing for us as the African continent. And so it's rethinking, if you're a VC company or a VC-backed company, then revenue growth is fantastic, but we need more than that. We need you to have positive unit economics. We need you to be profitable, and that's the only way we will exit. And so if that's the case, then we need to build for that type of a market. Yeah.
Over to you, Jason. Aspirations for the space and what role do you see yourself playing?
I think the first thing is that the one thing I always want to see is that we don't need the day we'll see a lot more companies being looked at from a success perspective in Africa. I mean, then right now we only have very few success stories in Africa. So the more we can see a lot of that success story happening, then that would really be an achievement for the ecosystem, in the sense that right now, if you think of any big innovation that is really remarkable in Kenya, you can only think of, if you thought a bank, is Safaricom, well, not EABL, because it depends on who you ask. But there are very few companies. So the moment I see venture capital actually playing a role in enabling that, because VC comes in and, to Arnold's point, takes you from point A to point B faster than you that could have gotten there by yourself. So that's by extension also what I want to do eventually. But then the second thing is when we see the local ecosystem being built by people who have done entrepreneurship before, to the exits that Arnold was talking about, if we see a lot more of those people participating in surfacing and resourcing other young entrepreneurs, then that will be an evolution in the ecosystem as well. And I hope, at least from what you're doing From Here Ventures, can catalyze a bit of that, because we believe in more than just the check, but we believe in enabling someone. The check is just an instrument that you can use to get resources. But beyond that, you need to build your markets, you need to build your network, you need to build to get efficient resource, let's say value addition that can enable you to get from point A to point B, not by yourself, but also by holding hands together, moving towards that direction. So that's what really I look forward to seeing in the ecosystem.
So there are two roles I see. One is on the venture capital front as DOB equity. When we invest, we want to be a sparring partner to the company. We want to be in the trenches with you, figuring out why the strategy we put in place is not working. And we want to think through the problems so that we can have a solution that benefits the both of us as company and investor. We see the role that we see ourselves playing is in investing in the spaces or in the founders that are struggling to get capital, but have a strong business that is ready for the VC industry. So we want to invest in those companies, large market, high growth, and are struggling to raise capital, because we want to be able to provide that capital long term. And how we see ourselves is we're catalyzing a young company moving from seed or Series A to raising even larger investments from global VCs or global investors. So we want to catalyze that growth. That's the role we want to play or the role we are playing. On a more personal front, yeah, I think to champion more founders and more investors to finding the right type of capital or the right type of investment or the right type of way we should be thinking about VC in the local space. I think that's something I'm passionate about. I think I'm also passionate about one day, raising my own fund. But I can only execute on that when I see others who've raised successfully deploy and exit.
Wonderful.
Yeah.
That's a great concluding note on exits. And I really like what both of you have said about founders deploying their own capital in the next generation of founders. It's happened before in other emerging markets like India, and I believe that it's going to happen here too very soon. Thank you very much, gentlemen, for your time. We really appreciate that you made time to sit down with us and have this conversation.
Thank you so much for having us.
Thank you so much. Yeah, Jason, fantastic. And Moses, thank you so much.
You're most welcome. Thank you.
Asante sana.